Most people are about to miss one of the most predictable wealth-building setups of the last 15 years. Not because the information is hidden, not because it requires special knowledge or a finance degree, because they are looking at the wrong number. Right now, while millions of investors are watching interest rates tick up and down, and stock prices move on every headline, a completely different shift is building underneath the surface. It has already started. Smart money has already begun to move. And by the time most people realise what happened, the window will be gone. This is not a complicated story. The data is clear. The pattern has played out before. And the investors who understand it are going to look back at this moment as the year their portfolio permanently changed. Here is the number almost nobody is talking about right now. S&P 500 companies are currently sitting on $2.8 trillion in cash. That is not a rounding error. $2.8 trillion sitting in corporate bank accounts, earning almost nothing, while shareholders wait. And here is why that number is about to change your financial life, whether you are ready for it or not. When interest rates drop, the cost of holding that cash instead of deploying it increases dramatically. Companies face pressure from their boards, from activist investors, from their own shareholders to start distributing that money. The most direct and reliable way they do that is through dividends. This has happened before, and the data from the last time it happened is extraordinary. After the rate-cutting cycle that began in 2009, S&P 500 companies increased their total dividend payments by over 140% in the following 6 years. The companies that led that dividend expansion outperformed the broader market by an average of 4.3% annually. That gap, compounded over 6 years, is the difference between doubling your money and nearly tripling it. Same market, same period, completely different outcome. And right now, the setup for the next dividend acceleration cycle is stronger than it was in 2009. By the end of this video, you will understand exactly why this moment is different from what most investors think, and what to do before the window closes. So make sure to stay until the end, leave a like, and let's start. Most investors think about dividends the wrong way. They look at the yield today and compare it to what a savings account or treasury bond pays. Right now, a 10-year treasury bond pays around 4.2%. A quality dividend growth stock might yield 2.8% or 3%. So most people conclude the bond is obviously better. More income, less risk, guaranteed rate. And that conclusion is going to cost them significantly over the next 5 years. Here is what they are missing. A bond yield is fixed. The 4.2% you lock in today is the same 4.2% you will be earning in 2030, in 2031, in 2032. Every year, inflation quietly erodes the purchasing power of that fixed payment. Your income stays the same. Everything it buys gets more expensive. A dividend from a company with strong free cash flow and a history of raising its payout every single year is something completely different. Microsoft paid a quarterly dividend of 51 cents per share in early 2020. By late 2025, that same dividend had reached 83 cents per quarter. That is a 63% increase in 5 years. An investor who bought Microsoft in 2020 was not earning the same yield by 2025. They were earning dramatically more on their original investment, while also sitting on a stock that had appreciated. The bond investor was still earning 4.2% on purchasing power that 5 years of inflation had steadily reduced. Think about what that means for your portfolio over a decade. 2 people invest $100,000. One buys bonds at 4.2%. One buys quality dividend growth stocks yielding 2.8% today. In year 1, the bond investor earns more. In year 3, they are roughly even. By year 7, the dividend investor is pulling significantly more annual income, and their principal has grown. The bond investor is still at 4.2%, watching their real purchasing power decline. But here is the thing most people miss. The really powerful part of this setup is not what dividends are paying right now. It is what they are about to do. And this is the part that almost no one in the financial media is talking about. Companies with strong free cash flow and low payout ratios have been deliberately holding back. Their interest expenses have been high. Their boards have been conservative. But when borrowing costs drop, their interest payments fall, their cash available for distribution increases. And historically, that cash flows directly and quickly into dividend increases. After the 2009 rate-cutting cycle, Johnson & Johnson increased their dividend by 27% over 3 years. Procter & Gamble raised theirs by 31%. These are not exciting companies. They are among the most boring, stable businesses on the planet, and they quietly made patient investors very wealthy through compounding dividend growth. Now here is what makes today's setup even stronger than 2009. Corporate profit margins right now are significantly higher than they were 15 years ago. And dividend payout ratios, the percentage of earnings that companies actually pay out, are lower. That combination means companies have more room to raise dividends dramatically while still maintaining their financial strength than at almost any point in the last 2 decades. The powder is there, the conditions to ignite it are arriving. Most investors are positioned for exactly the wrong thing. A 36-year-old software engineer put $18,000 into 3 dividend growth stocks in early 2022. That was right when rising rates were hammering equity valuations, and most investors were running toward bonds and savings accounts. He was not making a complicated bet. He picked companies with payout ratios below 40%, free cash flow that covered their dividends comfortably, and at least 10 consecutive years of dividend increases behind them. By early 2025, his annual dividend income from that original $18,000 had increased by 34%. Not because he added money, not because the market had performed extraordinarily, but because all 3 companies raised their dividends, as they had every year before, as their cash flow supported them to do, and his original positions had also appreciated. He did not time the market perfectly. He did not predict when rates would move. He just understood the mechanics and bought before most people recognized what was building. The math that most people never actually run on dividend growth investing is the part that changes everything. Take $50,000 invested in a portfolio yielding 3% today with 8% annual dividend growth. Reinvest every dividend payment. Do not add another dollar. After 20 years, your annual dividend income alone exceeds $14,000. That is the 3% yield you started with, growing into 28% on your original investment. Every single year, without touching the principal, without timing the market, without predicting which sector will outperform. Just patient compounding of a growing income stream. That is what serious dividend growth investing actually looks like at the end of the runway. And right now, the conditions for that machine to accelerate are better than they have been in years. Falling rates, record corporate cash, low payout ratios, activist investors pushing companies to distribute more. Most investors are sitting in fixed income instruments that will lose relative value as rates fall, or in growth stocks with no earnings, waiting for a catalyst that may never arrive on their timeline. The setup is not complicated. It is just not obvious to most people yet, and by the time it becomes obvious, the best entry points will already be gone. Picture yourself 3 years from now. Rates have dropped. The dividend acceleration cycle has played out exactly as the data suggested. The companies you bought before it happened are paying you 30%, 40%, 50% more in annual income than they were when you first invested. Your portfolio has appreciated alongside that income growth. You did not predict it perfectly. You did not get the timing exactly right. You just understood what was building, positioned yourself early, and let compounding do what it always does when you give it time and a growing base to work with. That is the investor on the right side of this window. The investor who waited for certainty, who wanted to see the rate cuts confirmed, the dividend increases announced, the financial media declaring the dividend boom official. That investor paid premium prices for the same income stream you locked in months earlier. The difference between these two investors is not intelligence. It is not access to information. It is the willingness to act on evidence before it becomes consensus. Tonight, open your brokerage account. Look at your current portfolio. Ask yourself one question. How much of what you own today will pay you more next year than it does right now? If the answer is not most of it, that is worth thinking about seriously before this window closes. Think about it. If you've made it this far, it means you're not the investor who reacts to headlines and follows the crowd. You're the one who looks for the pattern before it becomes obvious to everyone else. That is exactly the mindset that builds real wealth over time. How much of your current portfolio is positioned for dividend growth right now? Drop your answer in the comments. Subscribe to this channel for more content that shows you what smart money is doing before the rest of the market catches up. And watch the next video. I already showed you the fastest way to double your money, and most investors are still missing it.